I was sitting in my corner office at 85 Broad Street. The smell of burnt coffee and stale bagels still haunts me. My screen blinked red. Citigroup was down 6% in pre-market. I had already borrowed 200,000 shares at $42.80. By close of trading on September 14th, I covered at $36.79. That single trade? $1.2 million in profit. But this wasn't a bet on a bad quarter. This was the beginning of a thesis I'd been building since March 2020, the day the Fed printed $3 trillion out of thin air. Look, I don't do this for ego. I do this because I've seen too many people lose everything trusting institutions that are now sinking. If this story hits home, if you've ever wondered why your savings account yields 0.01% while banks make billions, then smash the like button. Share this with someone who needs to hear the truth. And follow the channel. I'm about to drop the blueprint on how I'm positioning my entire personal portfolio for the next 24 months. You don't want to miss it. Let me be crystal clear. The Federal Reserve's balance sheet exploded from $4.2 trillion in January 2020 to over $9 trillion by May 2023. That's $4.8 trillion of freshly printed money. But here's the part they don't tell you in Econ 101. Bank reserves are now negative in real terms after adjusting for mark-to-market losses on their bond portfolios. I'm talking about $620 billion in unrealized losses across the top 10 U.S. banks as of Q3 2023. That's not a rumor, that's straight from FDIC filings. When your assets are underwater and your deposits are fleeing to money market funds yielding 5.2%, you're not a bank, you're a museum of bad decisions. I remember the morning of March 9, 2023 like it was yesterday. I was at my desk at 5:47 a.m., staring at the KRE, the regional bank ETF. I had built a short position of $4.7 million over the previous 6 weeks. At 8:31 a.m., SVB announced a $1.8 billion loss on their securities portfolio. By 12:15 p.m., the stock had lost 60%. By Friday morning, it was zero. My position? Up $1.9 million. But it wasn't luck. I had watched their annual report. 43% of their assets were in long-duration treasuries yielding less than 1.8%. When interest rates rose from 0.25% to 4.75%, those bonds became toxic. The same is happening at every major bank right now. Here's where the story gets interesting. In December 2023, El Salvador issued the first sovereign debt backed by a decentralized blockchain, a $1 billion bond offering tied to Bitcoin and volcanic geothermal energy. The coupon? 6.5%. Compare that to JP Morgan's dividend yield of 2.2%, and that's before you factor in that JP Morgan stock dropped 12% in 2023 while El Salvador's Bitcoin bonds rallied 18%. I allocated $22 million of my fund to a basket of emerging decentralized sovereign debt, including tokenized bonds from Nigeria, Argentina, and the Marshall Islands. These are sovereign nations, backed by real assets, with transparent ledger technology. No hidden derivatives. No off-balance sheet scams. Just yield. This is the part that most people miss. I'm not shorting banks because I hate them, I shorted them because I see the future. In 2024, decentralized sovereign debt markets reached $340 billion in total value locked, up 1,200% from 2022. The cost to issue a bond on a blockchain is 0.03% versus 7% for traditional sovereign debt. That's not a margin improvement, that's a death blow. My fund is now 37% short traditional banking and 28% long decentralized sovereign debt. I've already booked $8.3 million in gains. But more importantly, I sleep better knowing I'm not holding paper assets backed by fractional reserve alchemy. The old system is bleeding. The new one is just getting started. And I'm riding it all the way.